Good morning, everyone. Tim Nyland here. Today is Wednesday, February 10th, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a topic you'd like me to explore in a future video, please leave a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. And don't forget to hit the subscribe button below to make sure you never miss any of our future calls. This week, we're going to take a look at Apple a little bit closer, and this is off the back end of a couple of strategy calls we've done here recently. Last week, on February 3rd, we looked at the outlook for mega cap tech, financial, and energy stocks, so it'll be a little bit of an extension of that. And then also wanted to refer you to a previous video on January 20th. That would be January 13th. Regarding what's Apple cooking up. We're going to refer to one of the charts in there, which was research and development as a percent of sales after Apple's most recent quarter that they reported, the fourth quarter, an update to that story. So anyway, a great little session here planned for today. We're going to do a little deeper dive into an opportunity here at Apple. One of the things that sparked my attention recently while I was on a call with a client as recently as Monday of this week, actually, doing a training session, was that the Zacks Rank for Apple was showing a strong buy. And what I've done for those users utilizing the Zacks Research System is I've actually put together a pitchbook of the charts that we're going to go over today. And we're only going to really go over 6 charts. And this is a pitch book that any of our support staff can help you actually set up. You can reach out to us. You'll have email addresses. And obviously, you can just contact your representative after you've watched the webinar to get access to this pitch book, help get assistance setting it up. So at any rate, whenever I see the Zacks Rank, strong buy, whenever I'm curious, I like to see if there's an analyst written research report. And I'll go ahead and show you what that looks like here. And you can see that the Apple recommendation, and again, this is very timely, just revised on February 1st, long-term recommendation, outperform, and a Zacks Rank of strong buy. So immediately, my curiosity is piqued. And so the very first place I'm going to go is take a look at that revision trend. And notice that I just clicked the down arrow in my Pitchbook page view, and it'll just scroll through your list here when you do that. And you'll see that we are looking at the F1 estimate, in this case, on 2.8 and even on 131, significant upward revision, right, by consensus. So 447 for F1 and 471 for F2. And you can see the growth rates associated with that, obviously, and the trend over time. So this is really important. Obviously, this is going to compound net margin growth. One of the things that we want to look at a little bit closer is that really popular chart that I showed last, January 13th, I believe it was. Apple's Cooking Up Something was the name of the webinar. And notice that R&D as a percent of sales that I spoke about in that particular webinar, as of that latest quarter now, reporting has actually rolled over. And this is an interesting trend, and one that I wanted to focus in on, do some valuation work with Apple ever since this latest ramp up in R&D really started back here at the end of 2011. And so I thought it would be a great exercise today to do a deeper dive into Apple and do some analysis on this 2011 time period to present, now that we've got this R&D that's actually rolling over a little bit. And so let's go ahead and start that. The very first thing I want to note, I'm going to go back up here to price and earnings really quickly, is to mention this double top again. Again, a very rare opportunity that you get to buy any of the big mega cap tech names, specifically the ones in the earnings certain portfolio tilt basket, the macro tilt basket of 6 names. So whenever I see that we've got this breakout in estimates, we've got R&D rolling over, obviously earnings estimate forecast revisions on the positive side, I like to do valuation work and extend that into some margin analysis to see if we've got some additional potential opportunities here. So the very first thing I want to do is I want to analyze those growth rates from 2011. Remember that it was in 2011 that Apple started that massive R&D spend ramp up. And you can see obviously where the price has gone since then. So I want to take a look at the growth trajectory in earnings. And then I also want to take a look at the implied bid to valuation from the buy side relative to sell side forecast. And we can do all of that with one screen in the valuation model. And you'll notice when I flip to the valuation model in my Pitchbook, I'm actually going to go ahead and do a right mouse click and set the history to that 10-year point. And that's going to get us all the way back to 2011. And the first thing that I'm going to do is I'm going to go ahead and click on this least squares growth rate because I want to see what this growth trajectory has looked like, right? We've had massive R&D investment. And you can see that this earnings line, very, very steady growth, compounded annually at least squares growth of 13.17%. Okay. And so this is a really, really important growth rate for us because obviously we've got a services business that's a higher margin business that's growing rapidly. We've got a wearables business that's growing rapidly. We know that the iPad business has been growing as of late. And with all of the new processors that Apple has come out with, based on the ARM technology, they don't even need cooling fans in their new MacBooks. It's definitely breathing new light into all aspects of the business. So this growth analysis is going to be really important. So specifically, what we want to do now is activate the valuation model. And to do that away from this least squares growth rate, I'm going to basically switch the least squares trend rate of growth to the actual valuation model by clicking on this default model. And the very first thing that you're going to see is that we have a model EPS growth rate of 10.21. And that represents the slope of what we're calling this normalized earnings line. And in prior webinars, you've heard me refer to this concept of normalized earnings. And it's very, very important when doing modeling that we assume what to be normalized earnings look like. And again, we're going to do that with Apple. The very first thing I want to draw your attention to is how different the growth forecast from the sell side is from the actual least squares growth historically that we've experienced since 2011. So if I just toggle between this least squares growth rate, notice that we've actually grown at about 13.17%. And then if we go back to the valuation model default, you can see that the sell side growth rate is roughly 10.21%. And if we try to back into the market implied growth rate, that's going to be the growth rate that actually sets the model into equilibrium. That growth rate is actually going to tell us what the buy side bid is on the implied valuation. So in order to do that, what we're going to look at is the current model return. And we're going to notice that it's actually negative 5.3. So we're actually trading at a PE of 30. The model right now, based on a consensus forecast for growth over the next 3 to 5 years, is 10.21. If we were only going to grow at 10.21%, you'll see that the model PE should be 28.41. And so the idea here is that we need to override the normalized earnings trend line. And let's just say that we've had some consensus estimate revisions. So we're going to go ahead and accept those, right? We know that those have been revised up. So the F12M fulcrum point, we're going to accept those. So the only real change that we want to make from this point is to change the growth assumption to back into that current model return to get it to 0. And to do that, what we're going to do is we're actually going to click on the right arrow key here, and we're actually going to move it 10 basis points per click. We're just ratcheting that up, and you'll see that that current model return begins to approach 0. We can actually force it to 0 by clicking on the market implied growth rate. And you'll see that that rate of growth is roughly 10.79%. So darn near the default consensus forecast minus 1 standard deviation. Really, really close. So the next thing I want to do is mention that this literally becomes our hurdle rate of growth. So this is the growth rate that you want to write down on a piece of paper. If you save the valuation model settings, it'll actually show up on your growth and margin view. I'll show you that in just a minute. But just keep in mind that the hurdle rate of growth for us as investors, as portfolio managers, is 10.79. So if we think that Apple can grow earnings long-term at greater than 10.79%, then we've got a buy opportunity here. And I want you to see the cyclicality of the earnings forecast in this super cycle. And you'll see that we've got 2021 EPS growth at 37%. This is not a surprise. This is the big iPhone 12 super cycle. And then that growth is forecast to cascade down to about 5%. Again, we have to think in terms of normalized growth, right? This 5% is low because it's off the back end of a very large 37% growth number. And then you'll see that we get a little bit more normalization out here to 2023 at 13%. 13% aligns with the least squares trend rate since 2011, which is interesting. Make a note of that, okay? So again, we'll go back to the market implied growth rate. Again, I'm just toggling between these buttons here. Least squares growth rate, you can see the tooltip here telling you that, and the market implied growth rate. So we've got a buy side bid to implied valuation at roughly 10.8. We have a long-term least squares trend rate at 13. And we have a sell side consensus forecast that says growth is looking like it's going to normalize out in 2023 to roughly 13%. That's after the iPhone 12 super cycle, and that obviously incorporates all the other lines of business of Apple. So if 10.79 is our hurdle rate and we have normalized growth forecast at 13%, perhaps we have an opportunity. I always like to say perhaps because the valuation model allows us to explore these analytical issues of relevance a lot deeper. And my favorite view, if you haven't figured it out by now, is the growth and margin view. And this is my very next view in the Pitchbook. And I just clicked on the down arrow and it's prompting me to save my changes to the model. I'm going to click yes here because it's going to take that 10.79 and it's going to put it down here as the analyst growth estimate, okay? The very first thing I want you to see is this long-term growth rate estimate. So there's the actual mean growth rate estimate. And to get to the default 10.2, we actually knocked one standard deviation off of it. We do that as a measure of conservatism, right? So in actuality, the buy side implied bid to growth is only 10.79. If we took the gross consensus forecast for long-term growth on the EPS over the next 3 to 5 years, it would actually be 11.5. But again, as a measure of a conservatism, we knocked one standard deviation off, which was 1.3. We brought it down to 10.2, okay? So when you're doing your growth and margin analysis on any company, the very first place you want to look is what's going on with the capital structure. And you can see that Apple has for years and is forecast to continue to buy back stock. And this is very important when you're doing growth analysis to understand the implications for any share buyback on the capital structure, as well as your ability to compare short-term growth rates to long-term growth rates for both EPS and revenues. Notice when you're buying back shares, it's obvious that your common shares outstanding will decrease. As those common shares outstanding decrease to the tune of 6, 5, 4% year over year quarterly, your difference between your actual aggregate earnings and your diluted earnings differs because you've got earnings divided by a smaller share count each quarter. So it makes it really impossible to compare growth rates on diluted earnings and diluted revenues. And let me give you an example. The December quarter was reported after one-time non-recurring charges were backed out. We had a before non-recurring items EPS of 168. That represented diluted EPS growth of 35%. But when you look at the growth rate in aggregate terms without the share buyback, it was only 29%. So the idea here is if we're going to take and look at short-term growth year over year quarterly and compare it to long-term trends and least squares growth rates, we really need to focus on aggregate growth when there's a share buyback and not diluted growth. Because if we're looking at diluted growth, it's being biased by the share buyback. And for the most part, the buy side will give credit for the fact that capital is being returned to investors, but it will not give credit for growth rates that are artificially inflated by a share buyback. So 29% is what the market is watching. And for revenues, it's actually 21%, not 26%. And you can see that on the trailing 12 basis, that's a huge difference, right? 10% revenue growth and 11% earnings growth. Now, the interesting thing is to take a look at the forecast periods. You can actually see the revenue ramp up here to 15%, earnings ramp up here in aggregate to 16%. So still that growth scenario playing out. Long-term trend rate for growth, 10 years on the revenue side in aggregate, 10%. 15 years, 22%. Okay, really important things to notice. So a nice sizable ramp up in growth for Apple. The idea is this hurdle rate of 10.79% sustainable and supportable? And we can answer that on this page for the next year. And when we start looking out beyond a year, we really need to focus on margin analysis and trend analysis. And the idea here is that we have sustainability and we have supportability over the forecast 4 quarters. And you can see that here with 15% top line growth and 16% bottom line growth, far in excess of the current bid to valuation that the buy side is assigned at 10.79. But keep in mind what the buy side is doing is it's looking even further out than this forecast 4 quarters. So let me remind you that this R&D as a percentage sales is now rolling over, and hopefully we begin to see the added benefit of the revenues continuing to compound off of this investment. So the idea is, where do we look next? If we're going to see a continued decline in these expenses, which perhaps this isn't a trend, then we'd want to take a look at the margin analysis. And this is the very last view in the pitch book. And keep in mind that margins are primarily cyclical for most companies. And if we take a look at that 10-year time period that I mentioned off of the back of that R&D cycle, you'll see that it's no different for Apple. And specifically, what I want everyone to notice is that this is a custom 4-panel chart. To find this particular view, you can either build it in your 1 to 4 panel here, just click here, create new, or you go up to custom. In the custom views manager, you will find this Zacks margin analysis absolute. Okay, so it's there. The idea here is that I've transformed the very top panel to not be just a revenue trailing 12-month number, but I actually assigned it to be a 1-year percent change. And that's the proper way to look at margins. You always want to look at a top panel that's based on 1-year percent change in revenues, and then you want to overlay that relative to your gross margins, your operating margins, which is EBIT margin. Remember, EBIT margin is operating margins. And then obviously your net margin, which is obviously net income divided by revenues. In this case, this is before non-recurring items, so this is adjusted. Okay. The revenue panel is in panel 1 up here, and I transformed it by simply just activating the list control and choosing that 1-year percent change that you see there. So very, very easy to use. The chart in default is already set up for that, so you don't need to worry about it. So the idea is, what is important about this chart? And the idea here is that we had maximum revenue growth year over year in 2011, just as that R&D spend relative to sales bottomed. And revenues have been on the decline year over year. Apple's been maturing as they've ramped up that R&D spend. Now we're getting to this cyclical phase, and it appears as though we're getting this ramp up, right? We're going from 9.88, and if we recall the analysis that we did in our last view, if I go back to growth and margin, we're going from 9.88 to, let me override that, to roughly, what was it, 21% net, 20% revenue per share. We're going to be going all the way up to 15% revenue growth in aggregate. Okay, so we'll go back here to the margin analysis, and you'll see that this 9.88 is forecast in a year to be roughly 15% in aggregate, not per share, but in aggregate. Keep in mind that as your revenue year over year percent change increases, so does potentially your gross margins increase off the back side of that. Okay. The idea here is that gross margins are cyclical and that perhaps we've bottomed and this is the start of a new cycle for growth margins. And it certainly helps that revenue growth is on the rise. We know that R&D expenses have come down, right? So there are other areas for operational efficiencies, right? When we talk in terms of EBIT, we are at the bottom of an operating margin cycle here. And so as revenues begin to increase to 15%, again, the further you go down the margin line, this is literally reading right down the lines of the income statement, right? Revenues minus cost of goods sold equals gross profit. Gross profit divided by revenues is your gross margin. Then you've got your earnings before interest and taxes. So you've got SG&A, R&D, everything else in here between gross and operating. And so to the extent we're backing down or rolling over on our R&D spend, that's going to improve our operating margin, okay? And then we get down to the net margin, which obviously takes out interest and taxes. And so the idea here is that for every increase in annual percentage revenue we make here, it could actually really set your net margins off. I don't necessarily want to say parabolically for Apple, but it's definitely greater than a 1-for-1 ratio on how that could impact net margins. And I think that's really the driver behind that EPS estimate forecast revision that we saw trigger that Zacks Rank to be such a strong buy. Do not ever underestimate the power of these mega cap tech names, or for any other name as well. The power of these margin cycles. They're real. And for a growth investor, this is one of your number one triggers for entry when you get a Zacks Rank, especially a strong buy, and you can point to your margin analysis sitting at the bottom of a cycle with forecast revenue growth to increase, in this case, from literally 10% to 15%, will have literally an exponential impact on the bottom line, which is what is driving Apple's valuation. Literally, earnings and net margin is the lifeblood of equity valuations, especially for Apple. So an interesting scenario here playing out. We used only 6 views in the research system, and we tied in 2 other webinars that we did in prior weeks. And so there's definitely some interesting things going on at Apple. For a growth investor, this represents a very, very unique entry point. Again, the reasons for that is we're sitting at the bottom of a margin cycle, specifically a margin cycle since we've had the latest ramp up in R&D that actually appears to be rolling over just a little bit. I'll be watching to see if this trend continues. These are some of the things that I keep a close eye on. But again, the other opportunity here is that, just like we saw with the mega cap tilts, the 6 stocks that we use for the ECP macro tilt, we've got a little bit of a breakout here in Apple. But all in all, you'll notice that, if we bring this chart out a little bit further, say to 20 years, and then we bring in the tilt portfolio in aggregate, you'll see that, and this is an equal weighted portfolio. All 6 of those names are doing roughly the same thing. We're not going to get into the valuation work of the remaining 5 names, but Apple is pretty indicative of that group. Excuse me, AAPL. So at any rate, something to consider. Again, just a very, very quick analysis on some of the additional opportunities that come with perhaps that Zacks Rank of strong buy. Things to consider. You always want to take a look at the implied bid to valuation. The buy side is assigning it relative to the sell side. We did that with the valuation model. We then went through the growth and margin check to look at the sustainability and supportability of our market implied growth rate of earnings long term. And we discovered that the buy side implied bid to valuation was a 10.79% growth rate. And it was supported by not only top line growth, but long-term lease squares revenue growth, that historically supports an 11% roughly buy side bid to valuation. So the idea is, again, when we're looking further out than a year on these growth rates, we really need to look at the long-term cyclicality of margins to determine the real sustainability of the trend that we're seeing. And again, we're focusing on this period from 2011, this latest period of R&D spend. So we bring the history back. Let's do that 10 years to 2011. Again, I'm doing this live. There's no slide deck for this week, and you can see that in fact we're sitting at the bottom of margin cycle, and these revenues are going to turn up, and that's what at least the forecast is saying. And then obviously we've got forecast increase in EPS, which will further drive this net margin. So anyway, hope that was helpful. That's about it for this week. If you did find this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below or feel free to email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and my Twitter handle is @TimNyland. If you're interested in getting started with advisor tools or the research system, if you're looking to upgrade your current subscription, or you just want to talk to somebody about getting this Pitchbook replicated on your own system, please contact our world-class support at advisortools@zacks.com or at zrs@zacks.com. Thank you very much for watching, and I'll talk to you next week.